I've mentioned before that since about the fall of 2020, I and various different lawyers, etc., who I work with, have seen an explosion in the number of people who are renouncing their US citizenship. The numbers are just going crazy, and I suspect that will continue. I think that we're going to see a lot more people renounce their US citizenship over the next 10 years than we have in the past 10 years. We'll see to what extent it starts to become noticeable to them and to what extent they start saying, hey, listen, let's clamp down on this. But one of the key areas, I did a video on the process, step by step, of how renouncing your US citizenship works. One of the key parts of that is the concept of being a covered expatriate or not. So today I'm going to cover a little bit about what is a covered expatriate, how does it make a difference for you, and we're going to kind of go through that in a little bit more detail. So if you haven't already, please smash the subscribe button, nail the notification bell, make sure you click all notifications so you don't miss out. Give the video a thumbs up if you like it, share it with your friends. Really appreciate your support. I'm trying to grow this channel, etc. And if you would like help with these things, if you're renouncing, if you want a second passport in order to be able to renounce, if you simply want a plan B, backup passport, if you'd like help with international tax planning, with figuring out where to go, with getting residencies, citizenships, all that kind of stuff, please reach out to us. You can book a call with me at calendly.com/Michael-Rosmer, link in the description below, or you can check out our websites, offshorecitizen.net, offshorecapitalist.com, and send us a message through there. Okay, what's a covered expatriate? A covered expatriate is somebody who has a net worth of $2 million or greater at the time that they expatriate, or they have an average tax liability for the previous 5 years of $161,000 adjusted for inflation. So it changes every year as the inflation rate. It started in 2016, I believe it was. So in other words, if your tax bill at the end of the year was $161,000 or greater, and that was the case over 5 years averaged, and again, kind of like taking into account, it's not actually that easy to calculate. So if you calculate it properly and it works out that way, then you are a covered expatriate, okay? Likewise, if your net worth was, so it's either or, it doesn't have to be both, it's either or, okay? This is something you ideally want to avoid. What are some consequences of this? What does this mean? Well, first of all, if you're a covered expatriate, you have an exit tax, okay? Otherwise, you pay your $2,300 or whatever it is as your fee, no big deal. Here, you have a deemed disposition of your assets, and now, okay, there's an allowable portion that's not taxed, and so, it's not entirely straightforward that it's a complete deemed disposition, but basically it's as though your assets at the time are sold. You say, okay, great, we pay tax on the difference between the purchase price and here, less those exemptions, and then you end up with whatever your tax is, and that's your exit taxes. For somebody with a lot of assets, this can be significant, right? That's the first consequence. The second consequence is for somebody who is a covered expatriate, if they gift assets to somebody inside the US after they leave, gift assets, money, etc., which is normally zero tax, right? So gifts given by foreigners to US citizens or US residents are zero tax, okay? There's no limit. You could give $100 million, $1 billion. Kind of makes sense, right? They're saying, hey, listen, bring the money into the States. We like that. We're happy with it. That is not true as a covered expatriate. If you're a covered expatriate, suddenly it is taxable, okay? Not so good. Now there's one kind of exception to that, and that is your spouse, okay? So your spouse can receive the income, and so there can sometimes be some planning here where maybe, for example, one person expatriates, say your spouse expatriates, you don't, or vice versa, and so the assets could flow from the spouse to the kids, so from you to your spouse to your kids, as opposed to from you to your kids, because if you gift from you to your kids, it's taxable. If it goes from you to the spouse to the kids, it's not taxable. Now, of course, there's the gift tax limits within that, so how does that work out? Not so great. Now, going back to how you calculate this, because, okay, figuring out the valuation of the assets, etc., that can be a little bit tricky for the $2 million if you're talking about private businesses. And if you're close, it pays to get a professional valuation. Why does it pay? Because if you have a professional valuation, then you can use that to defend yourself. If they come back and they say, oh, do you know what? It seems to us like you have assets over $2 million. Now all of a sudden, this is a tricky thing to try and adjust. So it's better to give it documentation than to risk it if you're close to that mark, okay? All right, that's that. For the 161,000 inflation, I think it's like 174,000 a year or something like that now. For that, keep in mind, this is federal tax, not state tax, so you can remove the state taxes. The self-employment taxes don't count. The Obama taxes for Obamacare don't count. So all of that is removed. Deferred compensation is typically not included in there, so that's good. You also get foreign tax credits. So again, it's notably what you actually had as your tax bill, not your income. So if you're thinking ahead, you can do some planning both on the income side and on the assets side. On the assets side, you can gift things away, you can put it into, say, a foreign non-grantor trust, and you can end up with not reaching that threshold because those assets aren't yours. So if you have what's called a completed gift, then they're not your assets anymore. Boom, you're done. And that can be really, really useful. Okay, so there's some good planning you can do there if you're thinking in advance. On the income side, you can potentially do some things where you can play around with how much income you actually brought in a given year. Okay, that can be useful. You could, for example, do a bunch of donations, right? That's one thing you could do if it was relevant. You could move abroad and take advantage of something like the foreign earned income exclusion. You could take advantage of foreign tax credits. You could, there's a variety of different things you could do in order to plan around that. In some cases, if a person can time when it is they're expatriating, they might be able to say, okay, I'm going to wait a year, I'm going to do it a year earlier, whatever, based on expected income, and kind of plan accordingly. The bottom line is, if at all you can do it, you don't want to be a covered expatriate when you expatriate. You just want to be a normal person, you expatriate, you're done. Which, by the way, is a reason for a lot of people who are contacting me today, or these days, are people who have made a bunch of money in crypto, right? If you're going to expatriate, it makes sense to do that before the crypto gets too high. Otherwise, you could become a covered expatriate. Or you might be in a situation where you say, okay, great, I'm going to donate some of these things to, or I'm going to gift them into a trust, I'm going to gift them some other family member, etc., and get myself under that threshold. So anyway, that's what it's all about. I hope that helps. If you have any questions, put them in the comments below. If you like the video, give it a thumbs up. We appreciate your support. Share it with your friends. And if you have questions, you can reach out to us. You can book a call with me, calendly.com/Michael-Rosmer, link in the description below. I'm going to look forward to seeing you guys on the next video.